Imagine this. You wake up, check your phone, and the safe haven you thought would help you sleep better is suddenly falling. Fast. Gold's red, silver's even redder. Your group chat is blowing up, panic is everywhere. But here's the thing. What's happening right now is part of a bigger story, one that started months ago. Today, we're going to unpack why precious metals rallied so hard, why they're now pulling back, and how the underlying mechanics actually work, so you can understand the moving parts without the noise. And just to be crystal clear, this is not investment advice. We're not telling you to buy or sell anything. This podcast is 100% educational.
The headline making the rounds is gold and silver are crashing. But what the headline doesn't tell you is just as important. Gold's recent 8.5% drop came after a massive rally, around 66% since January and 28% just since August.
Exactly. Context matters. If someone only looks at this week's chart, it looks dramatic. But if they look at the entire arc, it's a pullback following a surge, not a wipeout.
And that's where headlines and reality often diverge. Headlines want shock value, but the market has mechanics.
Let's break it down. Here are 4 big macro factors that pushed gold upward earlier in the year: falling real yields. When inflation expectations stay sticky and central banks hint at easing, gold can become more attractive as a hedge. Central bank buying. Several emerging market central banks, especially in Asia, increased their gold reserves steadily. Geopolitical uncertainty, wars, elections, and rising tension often lead some investors to look at perceived safe havens. Weakness in confidence assets. When people fear volatility in equities or bonds, they sometimes diversify into gold.
This wasn't a weak market creeping upward, it was sprinting. So when prices finally turned down, it wasn't out of nowhere. It was part of the cycle.
Let's flip the coin. Here are 5 mechanics that often contribute to pullbacks like this. Real yields rising. If inflation expectations cool, but central banks keep rates higher for longer, bonds become more attractive relative to gold. Dollar strength. A stronger dollar makes dollar-priced commodities more expensive globally, which can slow demand. Positioning and leverage. Futures markets can be crowded. When key levels break, stop-loss orders and margin calls accelerate the move. Exchange-traded funds flows. Outflows can lead to unwinding exposure, amplifying the pressure. Physical demand shifts. If large buyers like China or India slow down temporarily, it can influence short-term pricing.
And here's something counterintuitive. Even as spot prices fall, retail premiums for physical coins and bars can rise if demand spikes and dealer inventory tightens.
Picture 3 overlapping layers. Futures. Fast-moving, leveraged, and technical. Exchange-traded funds. Institutional flows that can shift sentiment quickly. Physical market. Slower, tied to refiners, mints, shipping, and dealers.
This is why people can look at their phone and see a crash, then walk into a shop and see higher premiums or sold-out coins. Same asset class, different layers, different dynamics.
Another piece of the puzzle is options. If a lot of call options expire worthless as prices drop, dealers who are hedging may unwind those positions.
That can amplify volatility, creating what some call a feedback loop. It's not magic, it's just mechanics.
A metals pullback doesn't stop at the spot chart. Mining companies often experience bigger moves than the metals themselves. Jewelry retailers may delay or hedge purchases during volatile periods. Central banks sometimes adjust their pace of gold accumulation depending on currency needs. Industrial users of silver, like solar and electronics manufacturers, may hedge forward when they see dips.
And crypto sometimes trades inversely to metals, sometimes alongside. It depends on the macro driver. There's no fixed rule.
Premiums in key hubs can offer clues about local demand. If Shanghai prices trade above international spot, that can hint at demand resilience in China. If premiums narrow or vanish, demand might be softening.
If you want to understand the metals market, not trade it, here are 5 neutral indicators many analysts monitor. Dollar index trend. Strong dollar equals potential headwind. Real yields. Falling real yields often support gold. Rising can pressure it. Exchange-traded fund flows. Inflows versus outflows give sentiment clues. Futures positioning. Crowded long positions can unwind fast. Physical premiums, a ground-level signal of real-world demand.
These are tools to understand, not signals to act.
These are hypothetical study frameworks, not predictions or advice. First potential bounce watch. How inflation data, central bank tone, and ETF flows evolve. Historical episodes show that certain macro alignments can coincide with stabilization phases. Second, gradual grind lower. Look at how previous downtrends developed when support levels failed and ETF outflows persisted. Recognize patterns without acting on them. Third, flush and reversal. Observe past cases where big volume spikes and sentiment washouts preceded rebounds. This is about mechanics, not timing trades.
If you're serious about understanding these markets better, not trading on emotion, here's your educational checklist. Understand the difference between physical bullion, ETFs, and leveraged derivatives. Recognize how time horizons matter. A retiree hedging long-term inflation has different objectives than a short-term speculator. Study how real yields, the dollar, and demand cycles interact historically. Be mindful that all investments involve risk of loss.
Lighting recap. The pullback followed a 66% rally since January. Metals are sensitive to real yields and dollar strength. Futures, ETFs, and physical markets can move differently in the short term. Macro mechanics, not headlines, explain a lot. Education gives context. Action is a personal and regulated matter.
If this helped give you a calmer view of the recent price action, follow the podcast, leave a rating, and share it with a friend doom scrolling through gold charts.
And we want to hear from you. What was your first gold or silver coin purchase story? What was the wildest premium you ever saw during a shortage? The best stories get a shout out in the next episode.
Until next time, stay curious, stay informed, and keep your perspective wider than the headline.
And remember, context beats panic every time.
This video is for educational purposes only. Vest AI does not provide investment advice, brokerage, or asset management services. Always do your own research before making financial decisions.